Vinod Karki joins us, Head of Strategy with ICICI Securities, to walk us through where he feels that the capex cycle is headed. Vinod, at the beginning of the year, there was a hands down consensus that capex cycle like never before had started. And I'm going to borrow the phrase from Mr. Birla that a capex Mahakumbh has started. But if I look at the recent headlines, drop in energy prices, high inflation, impact coming on global demand trends, do you think the capex cycle which we are anticipating and which we are experiencing could be off track?
Yeah, good morning, Nikunj, and thanks for having me on the show. So, our reading when we look at data and what we've experienced through cycles is, first of all, these cycles don't, they have false starts, but if the conditions become right, then it's not as if, rising costs and inflation is a detriment. In fact, if you look at the breakup of, the gross fixed capital formation, and especially within the private corporates, if you were to look at it, the heavy lifting is done by most of these commodity companies and heavy industrial companies like utilities and even telecom and others, which were under pressure in terms of cash generation over the last several years. So the conditions and if you have seen initial signs of improvement, they don't reverse within a year or so. That's been our observation. I mean, these cycles are long trending, and they in between you have at times some slowdown, hiccups, up and down, but the cycle continues on its trend despite some of these short-term challenges. And what is happening is we looked at what happened is in 2011-12 is where we peaked out in terms of the capex cycle. And if I were to just break it up, not all components were dragging it down. So the main components, which are the heavyweights, which which were dragging it down, was the industrial private companies and the real estate investments, basically. While what was giving it a lift was services sector corporates, which is like communications, IT services and all, and the government, their share was rising, basically. So, but the point is the real estate and industrial corporates had almost a 60% weight in the gross fixed capital formation in 2012, which is fallen to 40%. And even if government tries and services sector try, their weight is not enough to lift the gross fixed capital. But what we are observing is that heavy industrials, which includes commodities and the other sectors I just talked about, are finally turning, basically, in terms of their cash generation capability and their demand outlook. These are the two key things which are required, right, and the animal spirits. Right?
So, Vinod, I'm with you. I'm completely with you that the cash flow in some of the companies now stands at unimaginable levels. But can I say that given how commodity prices are coming down, maybe there is a thought that recession is around the corner, and if prices they come down another 15-20%, one is better off delaying these capex cycle. My question is perhaps a flavor of what I asked you again. Will a drop in global demand or a fear of recession, could this force CEOs and financial planners to rethink on capex?
Yeah, that's a very important question. So, but the point is the commodity prices, although they might correct, but the level, if you see, they're still high compared to what we have seen over the last decade or so. But the bigger thing is underinvestment over, let's say, even years together of underinvestment. Some of these industrial sectors like utilities, metals, telecom, the underinvestment is what I'm more worried about, is because if you see the latest capacity utilization was around 74.5 as per the RBI, and and that's for Q4, and Q1 we have seen further traction in terms of demand. So I won't be surprised if this number moves in the 75 to 80% capacity utilization levels. So, and if you were to just extrapolate it over the next year or so, demand can be slow, but still it will be there. And with these kind of capacity utilization levels, and cash at their disposal, some of these sectors, I mean, I'm not saying across the board there is capex possibility, but the ones which matter, which is energy, metals, utilities, telecom, I don't think infrastructure, I mean, these are the heavy lifters, and real estate, I mean. So you have to, as I'm saying again, real estate doesn't come on a balance sheet of a company. It comes on the balance sheet of a household. And that sector is turning, basically. And as I said, in 2012, real estate investments by households were 37% of gross fixed capital formation, which fell to almost 25%. And we are seeing very strong, signals that absorption is rising and new projects are being launched. Eventually, there will be a problem of over enthusiasm and misallocation of capital. But these are the early 1 or 2 years of expansion of the real estate cycle. One cannot immediately say that this will go, and that's a large pie of the investment cycle. So that is where the positivity comes in. Government was anyways pulling enough, and they are going to pull enough more. Going by the tax to GDP number, we are confident based on their cash generation again. So from a cash generation and capital expenditure perspective, both for the government and the private corporates, feel confident. And if capacity utilization continues to nudge up above the 75% level, I don't see, and the years of underinvestment in some of these heavy industrial sectors, that's the key for me. So that will play catch up rather than doing a one-to-one correlation between immediate demand and investment. These sectors have seen years of underinvestment. So that's catching up.
Good morning. This is Nantar also joining in the conversation. Now, what we saw ICICI Securities do, I think about a fortnight ago, was give a target of 19,000 for the Nifty by the end of this financial year. But for a shorter term, when we talk about, let's say, the calendar year, and it's a conversation we've been having, what are you telling your clients and what should our viewers brace themselves for? Negative returns, neutral returns, let's say by 31st December?
Yeah, so our models, whenever we run our frameworks, it clearly tells us that when we have sharp drawdowns in stock market, and if the overall demand environment is not too bad, and there is no, huge financial risks, where balance sheets can go bust and all, post a sharp correction, the expected return should be higher, in my view. So I don't see, anything can happen, but the higher probability would be for, even by this year end, reasonable positive returns from these levels.
Okay, so you are expecting a positive close for the Nifty from these levels. We, of course, started the year up from higher levels. So let's see for that. Vinod Karki, thank you so much for being live with us today on the show. Look forward to more interviews.